We've been getting the question a lot lately of how to include the value of the assets into the small business that we're buying. I see a lot of really well-intended but completely misguided advice in the various message boards out there that we look at. Now, the big mistake is a lot of people say that you pay a multiple of the cash flow plus the value of the assets, and that's just wrong. The business is really worth a multiple of the cash flow. There are other valuation methods out there. There's like discounted cash flows, but really at the end of the day, whether you're looking at a small business, whether you're doing a private equity deal or you're looking to go and buy a stock in the S&P 500, it's typically businesses are bought and sold on multiples of cash flow. So the mistake we see is that people look at a business, say generating $1 million of cash flow. $1 million business might sell for 4 times, 3.5 to 4 times, let's say 4. So that business is gonna sell for 4 times cash flow. So it's a $4 million business. But then typically you have people that come in and say, well, then you have to add the value of the assets. And that's just wrong. The business is worth $4 million. And the assets are what are used to generate that $1 million per year of cash flow. And the value of that asset is included in that $4 million valuation. Now, where this becomes an issue is if, say, the assets are actually worth more than the multiple of cash flow if you were to liquidate the business. So someone says, I could sell the assets for $5 million. And the answer is, well, you should sell it for $5 million, liquidate the business, close it down. It's not generating an economic return, thus probably should go out of business. And as an economy does that, of course, it reduces competition. It means that that'll help push up margins for the remaining players. And that's how economic cycles work, is if too much money gets invested in an industry, those assets can no longer produce enough value to justify their existence, essentially. So if you have an industry where the assets aren't generating enough cash flow to justify the value of the assets. One, the assets might be overvalued, but it's just time to start closing businesses in that industry. And it's sad to see, but that's what happens, is that essentially no one in the industry can really make a profit. The weakest players start to go under. That leaves the strongest players with higher profit margins, and they can continue to operate in that industry.